Here's our part 3 for chapter 4 video lecture, where we're going to go through some examples of taxable entities, that's C corporations, versus flow-through entities, that's S-type corporations. So we have Nicole, who is forming a business with a C-type corporation, and this C-type corporation, called CCS, has taxable income for the year of $350,000. And after paying its taxes, the corporation will use the remaining money to pay out as a dividend. Now, typically, most companies will keep some of its profits so it can grow the business. If you pay out all your earnings, that means you're going to stay the same size. In fact, with inflation, you probably will start shrinking in size. But we're using these assumptions here. All the remaining profits is going to be distributed as a dividend. Now keep in mind, when a corporation pays out a dividend to its shareholders, that dividend is not a deduction to the corporation. Okay, it's a return of the profits, return of the capital investment by the owner, not a deduction. In the third bullet, we're told that the marginal tax rate for Nicole is 32%. Keeping in mind it's a graduated rate, but for simplicity purposes, we're just using the high marginal rate. And we're told that the dividends, which she's collecting from this corporation, we're assuming it's qualified dividends, is taxed at 18.8%. That's 3.8% for the net investment tax rate, and another 15%. You remember, we get taxed either at 0, 15, or 20. So we're told here to assume it's 15 plus the net investment tax to get a total tax on the dividends of 18.8%. If Nicole organizes CCS as a C-type corporation, and that's the default. If you form a corporation, automatically it's a C-type. If you want to be an S-type corporation, then you got to file an election with the IRS using that form I think I showed you back in the first video for this chapter. The question here is, what's the overall tax rate? In other words, what's the total tax the corporation pays plus Nicole and her husband pays divided by their total income? So here is the income. Here is the income. Is there a husband here? No, not in this example, just Nicole by herself. So here is the corporation's income. Remember, this is revenue minus deductions of the corporation to get taxable income. And we apply a tax rate of 21% to get a tax of $70,350. This 21% flat rate is something new beginning for 2018. In past years, it was a graduated rate, something like 15%, growing all the way up to almost 40%. Typically averaging out, most people would use 35%. So definitely a tax cut for corporations beginning in 2018. Now the remaining amount of profit she has, that's this taxable income minus the taxes she has to pay, is the remaining profit now she can distribute out. Keep in mind that a corporation cannot pay out the amount of capital that was invested, right, as a dividend. It's only the retained earnings, or the tax term is called earnings and profits, that they can be paid out. So that's $264,650, and Nicole will pay a tax rate of this 18.8%, giving her an individual tax at $49,754. So if you add up the tax for the corporation with the tax for the individual, the total taxes for her and her corporation is $120,104. And if you divide this by the total income, this is telling you for every dollar that the corporation had earned, to get money into her hands, the corporation and her had to pay about 36 cents. Yeah, which is kind of high because we're not even looking at things like state income tax here. Yeah, so maybe there's some kind of things she can do to reduce that tax. But let's take another assumption here. This time Nicole is going to still have a C-type corporation, and this time, you know, most startup businesses, they run losses. So she has 50,000 of losses. Her corporation has 50,000 of losses. She has a marginal tax rate as an individual of 37%. And this time now she's married. She has a husband earning 200,000. So how much tax will CCS pay in this first year of business? And also how much tax will Nicole and her husband pay on their income? That's Nicole's husband's 200,000 and any income coming from CCS or any loss. Here we're told that CCS, the corporation, will pay 0 taxes because it has a loss. You don't pay taxes on losses, right? You pay taxes on net profits, taxable income. But now the corporation should be able to carry forward that $50,000 loss into the next year. But doesn't the loss flow through to Nicole and she can deduct it on her return? Well, that would be true if you were looking maybe at an S corporation. Here we have a C corporation that keeps its income and losses. And again, the 50,000 loss will be carried over to next year for CCS. So Nicole and her husband will be taxed on his salary times their rate, or here's 74,000 for the year. Let's make another assumption. Suppose now that corporation is an S type. So we know this loss is going to flow through to the owner, the shareholder, Nicole. Also keep in mind, if this was not a loss but taxable income for the corporation, that taxable income will be taxed on the shareholder's return, no matter if it was paid out as a dividend or not. In this case, a loss. So you combine the loss with Nicole's husband's income to get 150,000 of income subject to their taxable rate of what was it, 37%, timesing it by 37% to get a tax of 55,500. And S corporations generally do not pay any taxes on its income. In this case, definitely it has a loss. So here's that situation again. Loss at the corporate level, be it a C or an S. Definitely no tax at all for S. And here tax only if there's income, which we have a loss. Nicole's other income with her husband. No pass-through or flow-through of the loss from a C. Here pass-through, flow-through from an S. So we get to deduct that, 50,000, reducing the taxable income of Nicole and her husband. Here at the same rate, and now she gets to deduct and reduce her taxes, saving her, what is that, little less than 20,000. So the lesson here, at least for a lot of startup businesses that generate losses, you probably want to run your business through some type of flow-through entity, either an S corporation or a partnership if you have a partner. Nicole doesn't have one. Maybe she can make her husband a partner, or maybe a limited liability company treated as a sole proprietorship. Yeah, so the loss will fall through. She gets to deduct the loss and not use a C type where there is no loss flowing through. This loss will be carried over to the next year of CCS. Next assumption, suppose CCS is organized as an S again, and Nicole's basis, this is her investment in the company, is 50,000 for the year. But in this first year, there's a loss of 100,000. Further assume that Nicole does not participate in CCS's business activities. In other words, she's a passive investor in this company. It's kind of hard to believe if you're the owner, you're the only person working in the company, you don't really do any business activities, but that's the assumption we're making here. Okay, she's a passive investor. So the question is now, how much tax can Nicole, how much will they pay taxes for Nicole and her husband? Again, the husband has the 200,000. They have the same $50,000 loss, but this time the loss is not an active business loss, but a passive loss. And more so we'll discover in the next chapter, passive losses can only be deducted in the year you have passive income. And this 200,000 of income from her husband, I assume it's work income, is not considered to be passive income. So it's still 200,000 income, taxable income, times that 37% to get that 74,000. Now you don't lose that loss. You get to deduct that $50,000 loss when there is passive income in a future year, or if Nicole sells or get rid of her stock investment in CCS. In that year you get rid of the passive investments, then the unused passive losses gets released and you can deduct it. Okay, another assumption. CCS again S Corporation, this time a whopping $1 million loss. Nicole has an investment basis of $600,000. So the question is, how much can Nicole deduct this year? We're assuming this loss here is an active loss. It's not a passive loss. Yeah. Okay, so we get by that passive loss limitation rule. Now another limitation is basis limitation. Her basis is, her investment is 600,000. She gets to deduct only 600,000 unless she has any more bases. Okay, and keep in mind there's also a limitation, new limitation of a dollar amount, a $500,000 loss limitation per year for married filing joint couple. Okay. So what does it say here? 500,000 is the amount they can deduct. And if the husband's income was 200,000, they probably have a $300,000 net operating loss they can carry over to the next year. How about the difference here of 400,000? Well, the 600,000 here, the $100,000 difference you can carry over to future years also and deduct it in that year when you do subject to that $500,000 basis. And this difference here, the 400,000, she can deduct it when she has basis in future years, maybe investing more money into the business. Okay, so I think